Today was a little bit of a snooze in the stock market. We basically closed at break even here today. We had about 50-50 split in the amount of stocks up versus down. So we spent a little bit more time in tonight's video talking about other things, including a major upheaval from a global industry classification standard perspective, where we saw a number of stocks in the S&P 500 changing sectors here all of a sudden. Stocks that are important like Visa and MasterCard, PayPal, Target, Dollar Tree, Dollar General, automatic data processing. So I'll kind of walk you through some of that information in tonight's video. We'll go through our traditional 12 grid analysis as well, where we've seen a little bit of a snapback in some things like treasury yields. We've had a really nice run out of developed foreign markets. We'll take a look at our sectors, where we have one sector that's falling back into a bearish posture here. And then we'll get into our trade application example, where I wanted to feature a dividend king as an iron condor candidate. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's April 18th, 2023. First of all, if you're new, welcome aboard. Remember to go over to our YouTube channel, click subscribe, and then once you've done that, go down into our description area. Make sure you're signed up for our email distribution list, so that way you can be notified whenever we post these videos. We'll also let you know which stocks are giving you overbought and oversold cluster signals in the S&P 500 at the bottom of those emails. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee. Really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook as well. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And I wanted to get started here real quick because I just got done posting this to Twitter here a moment ago, and figured it'd be a little bit easier to show you this way compared to the normal way of looking directly on the Thinkorswim platform, since I was able to kind of mark this up a little bit with some markings here to show you a little bit different visual as to what I have been kind of explaining to you guys over the last couple of weeks. It's been very interesting, to say the least, the lack of selling pressure that this market has experienced here recently. So, you know, some of you probably have recognized that with your own trading as well, and wondered, you know, is this normal? Is this typical? Not in this current era that we've been in. It certainly isn't. What I have here in front of us is a one-year chart of the S&P 500. And you can see I've got this box over here towards the right that says 18, and I've got this box over here a little bit further back to the left that says 17. And as you can see from my tweet, just quick information here that says the S&P 500 has now gone 18 days without a 1% drop. This is currently the longest streak of the past year, eclipsing the 17-day streak back in August of 2022. Many of you know that I like to sell puts on days when the market is down 1%, and I've kind of felt like I've just been twiddling my thumbs from that perspective. Fortunately, in my put selling class on Monday afternoons, we have been continuing to do that nonetheless, but in my own personal accounts, I've been kind of, you know, waiting for a little bit more of a sell-off day, because volatility, of course, goes up on days when the market goes down, and you get a slight benefit when you're willing to take on somebody else's risk by selling puts. But just have not had that opportunity lately. So I know a lot of you like to tune into these videos to see some of those trade ideas I bring to your attention when it comes to selling puts. And believe me, I'm watching day after day after day. I am watching and just sitting back in astonishment, watching this market grinding higher day after day without you know, any sort of a real give back. So does that mean that there's a little bit more pent-up demand for a little bit more of a sizable give back when it finally happens? Perhaps, right? There hasn't been enough of that release valve, so to speak, for the bears here lately. So it might have to cut a little bit deeper when that does eventually happen. So anyway, that's the newest, latest, greatest statistics there. We are now on the longest streak of the last year without a 1% drop in the S&P 500. All right, let's go back over here now and take a look at what happened today with the heat map. And as you can see, it was a pretty mixed session. In fact, it was a bit of a snooze type of a day, if I'm going to be honest. The S&P 500 closed up, but just by the slimmest of margins. You could call it flat. And we have kind of a split here in terms of market breadth as well, where we've got some of our bigger players like Apple and Nvidia closing in the green. Then again, you've got Microsoft and Google closing in the red. You had JP Morgan, Bank of America closing in the green, but you had Johnson & Johnson and Tesla in the red. So you can see it's not even one of those days where a lot of times we kind of get the sense that it's a mega cap versus small cap story or something. But today was really just a mixed bag across the board. Another thing I should mention real quick, I know many of you follow me on Twitter, and so you'd have seen me tweeting a lot about this over the weekend. But for those of you that don't follow me on Twitter, be aware that the global industry classification standard had a major upheaval within the last month. And it was a little bit surprising to me because I really haven't been hearing many people talking about it. In fact, I didn't hear anybody talking about it. But the reason that's coming to my mind right now in this conversation is because you'll notice that Visa is no longer on this graph anywhere. Either is MasterCard, either is PayPal. There were a number of stocks that are going to be shaken up from a industry perspective. In fact, in case you're looking for it on Twitter, maybe I could just go back and show you since I was just on Twitter there a moment ago. And it would have been like Friday, Saturday, Sunday, somewhere in that general vicinity when I was talking about this stuff. Where was it? There was a couple of them. Here's one that might be helpful for some of you that are interested in sector rotation, by the way, as well as sector roadmap there. But it wasn't that one that I was thinking of. It was... Here's one of them right here, and that was on April 15th. So remember, if you just go to my timeline, you can go back in chronological order. So on April 15th was one of them where I posted a bunch of stocks and their sector changes. And then that same day or same night, because I think this was Saturday night, if my memory serves me correctly, there was another kind of a tweet thread that I put together with 11 different tweets in it that details all of those changes, and there were tons of changes. This is not some sort of just an afterthought of a change. This is a major upheaval that took place here, where you had entire industries that were created out of the clean blue sky, and you had other industries changing their names, and you had a lot of upheaval in terms of the stocks that are changing within the market. Here are some of the bigger ones within the S&P 500 itself. And that includes automatic data processing, which of course is a dividend aristocrat. And for the longest time before IBM joined the aristocrat list, ADP was the only technology company on the aristocrat list. Well, I couldn't make that claim anymore because they have changed officially from the tech sector into the industrial sector, as has Paychex and Broadridge, and then further down, kind of below this black line right here, you'll see another major upheaval where a lot of tech stocks are now going to be transitioning into the financial sector. And a couple of them are ones that people probably thought were in the financial sector all along. But those of us in the business have known that Visa and MasterCard have been technically considered technology companies since their IPOs. Well, that is now officially changed, and they are part of the financial sector. So while American Express and Discover Card and Capital One and those types of companies have already been financials companies because their business model is a little bit different, where they're backing up the loans and things like that. Visa and MasterCard are more transactional, kind of facilitating the transactions. But at this point, they have decided, let's put them over there in the financials anyway. So, of course, those two have massive market caps. $450 billion out of Visa, $336 billion out of MasterCard. Those are a couple of the top 20 biggest companies in the United States right there. PayPal is also a big company at $83 billion. And of course, they're changing in that regard as well. And then down below, some important retailers are changing. So, kind of like I said in the tweet itself, that Target is finally joining Walmart as a consumer staple. So kind of like Visa and MasterCard with the people I've worked with over time with our education business, a lot of times people would have assumed that Target and Walmart would have been in the same sector already, but it was kind of just an oddity that they weren't. Walmart has always been a consumer staple. Target has always been a consumer discretionary stock. Well, that is changing officially as well. Target is now joining Walmart as a consumer staple company, as is Dollar General and Dollar Tree. Now, I'm bringing all of this up because Thinkorswim has not officially updated everything yet. I've seen some instances of things that they've updated, but they have not updated everything across the board. And so if you pull up various watch lists on their market watch area and look at the sector and industry column, a lot of them will just be empty at this moment. So if any of you have contacts over at Thinkorswim, you might want to let them know to get that updated sooner rather than later, because a lot of us are relying upon this data. Some of you might say, well, Brandon, don't you have contacts over there? Sure, I still know a number of people that work over there. I'm not sure they necessarily want to hear from me. Of course, David and I really enjoyed working with our coworkers over there. Have the most amount of respect for all of those old coaches that we worked for, but we have zero pull with the management team over there these days, and they probably don't even want to hear from us. So maybe you guys as clients have an opportunity to get in their ear a little bit about getting this sector update done, because I have a feeling that other brokerages have. In fact, I was over on the Fidelity website and I did notice that they've done their updates over there. So Thinkorswim appears to be a little bit behind the curve on this deal. And so this is not a full reflection today of the S&P 500 for that reason. Visa and MasterCard, PayPal, those companies aren't even on here at this moment. So just be aware of that. A little bit of a glitch at this moment. And remember, that's a pretty big upheaval. Several years ago, we had that upheaval where we had all the real estate investment trusts get pulled out of the financials sector. In the old days, the REITs used to be part of the financials. That one, obviously, in my head at least, made a lot of sense, because REITs and financials, like banks, oftentimes move in different directions depending upon interest rate sensitivity and things like that. So I was definitely on board with that idea of pulling the REITs out of the financials, calling them a separate real estate sector. And then we also had a pretty big upheaval here a few years ago when they changed the name of the old telecom sector to the communication services sector. And they basically put a bunch of the internet companies like Alphabet and Meta and them into the communication services area to basically join AT&T and Verizon, because towards the end there was hardly any actual telecom companies left. And so they were pretty much an afterthought sector. So that kind of helped them beef up that sector a little bit. By the way, another one of the bigger changes in that regard, and again, you guys can get into the details of this if you need to on my Twitter feed, but another one that I'll just mention here real quick because it is an important one these days, is that there is a industry called Internet. What was the exact name? It's where Amazon is, so that's why I'm going to bring it up right here if I can find it real quick. Should have had this pulled up before I started recording here, but sometimes this stuff just comes to me while I'm in the middle of recording things. But anyway, it's like something like direct internet and direct retailers or something along those lines. And so Amazon is part of that. So that's a really big industry from a market cap perspective as well. eBay is in there. A handful of other kind of internet related names are in there. They've changed that name now to I think it's like Broadline Retail. So that's another one where if you kind of go and look for it on the watch list. So if I were to come over here to the watch list and go to something like, I don't know, let's just pull up a public watch list of the NASDAQ 100 and then sort this by symbol. And if you look at Amazon as an example right here, I'm kind of circling it with my mouse. Notice how it does not show the sector anymore. It used to say consumer discretionary. And then the industry right here, it no longer shows either, because that used to be that old one that was known as, internet direct marketing and retail or something along those lines. And now that particular industry group doesn't even exist anymore. And so once Thinkorswim gets it together, whenever that will be, I have no idea. But eventually, if they go through their updates the right way, those will be replaced with the new areas where they are officially housed, like broadline retail and some of those things. Another big one, by the way, that I saw that is going to be a pretty massive shakeup is how they're handling the REITs. And so, like if we go to a watch list of REITs, notice that most of the REITs no longer have any industry that's listed there. They're mostly blank. There's a huge upheaval taking place on REITs. It's not that the REITs themselves are changing to a different sector. They're going to stay in real estate. It's how they're handling industries now. In the past, they had just two industries. It was like equity, real estate investment trusts, and then this other one, real estate management and development. Now they've taken that old one of equity, real estate investment trust, which was the bigger of the two, and they basically chopped it up into like 7 or 8 kind of sub industries where you're going to have more fine detail in how to divide those companies up. So for instance, you're going to have office REITs, you're going to have hotel REITs, you're going to have healthcare REITs, and all of that needs to get updated on the Thinkorswim platform still. So somebody over there is going to have a big job in front of them, and I'm kind of waiting myself because a lot of you know I do a lot of sector and industry tools for market scholars, and a lot of my data derives from Thinkorswim, and so I'm kind of sitting here hoping that they're going to get their stuff taken care of so that way I can start working on my stuff and so on and so forth. So we'll see. I have no idea. I haven't heard at all what an ETA is on that. I just recently learned of this myself, and so I thought I would pass that information along to many of you who might also be curious if you've seen weird, glitchy things on the Thinkorswim platform here lately when it comes to sectors and industries. Anyway, back over here to the heat map. You can see it was pretty much a mixed bag here today. We're kind of getting into earnings season now, as you're probably aware. We got into the banks last week. We had some other fairly big companies report here tonight. In fact, Netflix had a report that was instantly sold off about 10% with the stock price in the after-hours session. But the last I checked, it fully recovered that entire move. Some of you might have seen my tweet there as well that Netflix is finally ending their DVD by mail service, which is, for us old timers, brings back good memories. I remember getting those red covered, DVDs in the mail way back in like the year 2000 and 2001. It was right after I got out of college. And so anyway, that program is now going to end officially. It's funny because my older brother still is on that program. So I had to let him know right away as well. But anyway, that apparently is going to end in September of this year. So it will only be streaming going forward. So it's going to be a little bit of a change there. But of course, these days, the DVD component is really small afterthought for the overall Netflix. So I'm sure most people will not even notice the change. But that will be probably the big stock that a lot of the commentators on TV and stuff will be talking about as we head into tomorrow morning's trading. All right, let's go ahead and see what the actual breadth numbers were here today on the visualize area. And you can see in the S&P 500, 244 stocks were up, 255 stocks were down. So it was a pretty even split here today, about 49% to 51%. So again, kind of a snooze of a day, all things considered. Definitely a tug of war between the bulls and the bears. As we take a look at our 4-grid now, this is chart 4B for those of you that are premium market scholars following along at home with your own charting package. With not a whole lot happening today, no surprise that there was no posture changes as a result of what happened today. So we remain with strongly bullish postures on 3 out of our 4 charts. That's the S&P 500, that's the Dow Jones Industrial Average, that's the NASDAQ Composite, and then the Russell 2000 is also bullish, but we would call it weekly bullish because the green line here has not yet gotten above the 50th percentile of that market forecast technical indicator. Whereas on these other ones, of course, they have. In fact, on all of the other ones, the green lines are not just above 50 and rising, they're in the upper reversal zone already and have been for a couple of weeks at this point for most of them. So those ones obviously knocking on the door of multi-month highs here recently. In fact, getting a lot of stocks hitting 52-week highs here today that many of you are familiar with from my various classes. McDonald's comes to mind. Clorox comes to mind. I was just tweeting about that a moment ago. Unilever comes to mind. So some of those dividend growth stocks are coming to life here once again and hitting new 52-week highs. I saw Lockheed Martin, another one of those dividend stocks, hitting a new high. So, quieter companies, not necessarily the most exciting names out there, but we do have some fairly decent participation on the bullish side of the coin. So as it stands, not a whole lot changed off of today's very boring end result. The S&P 500 was up a whopping 0.09%. The Dow Jones finished just below break even at a 0.03% loss. The NASDAQ was similar with a 0.04% loss. And then the Russell had a little bit more movement, but still not a big deal. It was down 0.4%. So pretty quiet day there, as you can see, and all of the charts have the same postures that they would have had yesterday, and they all have the same color of moving average as well. And similar to what I'd mentioned before when I suggested that the Russell 2000 was the weak link out of these four, you can also display that not just through the green line down below, but also looking at what color the moving average is. And right now, Russell 2000 color is yellow. In this case, that means price is above a falling 30-day moving average, whereas the moving average colors on all three of the rest of the charts, as you can see, are green, telling us that price is above a rising 30-day moving average, and those are more bullish features for charts traditionally. Let's take a quick peek here at our three green arrows chart, see where we stand with that. And not a whole lot of change, although there is one thing to report. You can see that since yesterday, the Russell 2000 lost its three green arrow status with a red arrow coming in on the stochastic. Remember, the stochastic traditionally measures where a stock is at upon close based upon a previous range of time. And when a stock is closing near the highs of its ranges, you're usually going to have a supportive stochastic. When a stock is closing near the lows of its ranges, then sometimes those red arrows creep in. And you can see that we did close in the lower half of today's range on the Russell 2000. So I'm sure that was part of the impact that resulted in a red arrow showing up there on that Russell 2000 on that particular indicator. The NASDAQ has a green arrow still on the stochastics. I know it's hard to see, so let me move that up. So it got that back here about a week or so ago, but the problem is we still haven't gotten the green arrow back on the MACD histogram. So we're waiting on that one on the NASDAQ. Otherwise, we've got two green arrows there. And then the two charts on the top, the S&P 500 and the Dow Jones, both have three green arrow status. So we've had quite a strong run of things. It hasn't been like knock your socks off type of a bull move that we've had. It's just been the consistency and the grinding higher that we've seen that's been impressive more than anything else. Let's see what our 1040 crossover method chart suggests. Remember when I was with you last week, we were talking about the recent changes that have taken place there, and those changes have held at this point. Of course, we're early on, but it's good to see that we haven't, given up the ghost right out of the gate. Sometimes that can be a frustrating kind of whipsaw experience. But for the last 3 weeks, we've had a bullish crossover on the S&P 500 and on the Dow Jones Industrial Average and on the NASDAQ Composite. So as you can see, another way to determine that the Russell 2000 is our laggard is it is the only one out of these four charts that continues to have a death cross on the 1040 weekly crossover method that we're using in this case. Remember, this is a 3-year chart that we're looking at here with each one of these candles representing 1 week in time. And the Russell 2000 is the only one that has the orange line still below the blue line. It's close, So I'm not going to say it's impossible for it to occur, but with that banking crisis that we've been going through here in the last couple of months, that kind of threw a cold, wet blanket on any attempt that the Russell 2000 would have had otherwise to get a bullish move up and over. So we're waiting on it. No guarantee that it's going to occur, but considering the other three charts have, you would like to think that if 3 out of the 4 are doing one thing, they would have the power to pull the 4th one up, as opposed to the opposite, the 1 out of the 4 not doing that thing, dragging the other 3 down, right? So we'll never know in the end, but obviously as things change, which they will one way or another, we will keep you abreast of that here in these market outlook videos. All right, let me go ahead and pop on over to the internet, and I always like to say thank you to those of you that help support us on Twitter and other social media networks. In fact, I had a fairly big milestone over the weekend as I crossed over the 15,000 follower mark. So thank you to those of you that might be newer to my profile as well. I hope I serve you well and give you lots of interesting things to think about here on Twitter as we move forward. But in addition to that, of course, I'm always an enthusiastic supporter of you guys getting me up and over 100 likes on the last time I did the Market Outlook video, which you guys did no problem at all. In fact, when I did this video on Thursday, I think it was by Friday morning, we were already up and over 100 likes. Sometimes it's kind of like one of those deals where you wait until the very last moment and we just barely get up and over right before I go to record, something like that. But that was not the case last time around. You guys stepped up to the plate, and as I always say, as long as we're up and over 100 likes, I'm more than happy to give you a full-length video. And if you want me to have a shortened video of only 15 minutes, then don't click like, because if we're under 100 likes, then I'll just try to abbreviate my thoughts with just the market indices themselves, as opposed to giving you the additional commentary about the 12 grid analysis and the trading applications and all that kind of stuff. So we kind of let you guys decide there in the end. But as I always say, it doesn't cost you a penny. All it does is cost you 5 seconds out of your day to click a button there for us. And for a lot of you, your 5 seconds in time, you're willing to trade off for the 3 hours of my time that it takes to create these videos for you for free here on YouTube. So please keep that up. It means a lot to both David and I. We really appreciate that. Let's do some shout outs here. Thank you to Dave, and thank you to Afra. Thank you to Anne and Doug and H. Battelle, and thank you to William and Serene and Dave and Nietzsche and Craig and Greg and John and Dividend Chart and Ken and Robert and Walt and NZ and Julie and Vodacon and Nina and Dave. There's my buddy Eric over at Fired Up Wealth. Also, thank you to Stephen and Terry and Evan and Doss and Brian and Ken and Dennis, Easy, Duncan, DGI and Options Daily, Oz Trader, Gene, Bruce. The list goes on and on and on. A lot of great supporters out there. Can't get to all of you, but I want to thank each and every one of you for taking the time out and doing that. Again, it goes a long way for a very small business like David and I are trying to operate here. So thank you very, very much. All right, let's also, while we're here, have a little bit of a chat about our sector selector. A reminder that the sector selector gets updated on Friday evening, so it's a couple of days stale by this point, but still can give us a fairly good idea as to the sector rotations that have been taking place here more recently. Remember, we use both this sector selector tool and the stock selector tool on Monday morning in my top-down trend trading class. So most of you that are premium members, of course, would have access to this information a lot sooner. Nonetheless, as you can see, this was updated on Friday, and for the 5th straight week, we have information technology leading the way. An impressive run of things there from the likes of Apple and Microsoft, and I think if I saw it correctly, I think NVIDIA hit multi-month highs, at least briefly here this morning. So that's been another big winner there that has been kind of part of this whole AI theme that everybody has been gaga over in the stock market in 2023. In second place is healthcare. For the second straight week. And healthcare had a pretty splashy deal over the weekend as Prometheus was bought out by Merck, and that was about an $11 billion deal. We've even had some of the more speculative gene editing and CRISPR stocks starting to perk up here a little bit more recently as well. So it seems like some speculation is back in healthcare, and it's not just the mega pharma companies, the kind of slow plotting companies like Merck and Bristol Myers and those types of companies that are leading the way. We had a period of time last year where that was the case. This kind of feels like a different type of a healthcare move that we're having with some of the up and coming growth oriented areas. We did have energy pop back up into the number 3 position, but a reminder that energy is very wild. I always say it's like riding a bucking bronc, and if you can stay on it for 8 seconds, you're doing pretty well. Energy's all over the map. This is an equal weighted version as a reminder as well, so it's not going to have as much of an impact from Chevron and Exxon as other market cap weighted versions of sector analysis would perhaps deliver for you. So that plays a role, but obviously energy stocks tend to do well when oil prices do well, and we've had a really nice shot higher in oil prices here over the last month or so, and energy stocks have kind of followed suit there. And then communications, discretionary, and so on and so forth. You will notice down at the bottom, financials have stayed dead last now for the 6th straight week. And of course, no surprise that largely started with the implosion of Silicon Valley Bank and the aftermath of that, where we've had some bounce backs in a few financials here and there, but it is clear, at least to me in my eye, that they have not bounced back nearly as much as other sectors have enjoyed this bullish move here in the last couple of months. So whether that will remain the case, anybody's guess. But it does seem like there's still problems there, right? That's one way you can kind of read into that. If the market is bullish and the area that just got bombed out cannot even catch a dead cat bounce, there's probably more cockroaches out there is one way to kind of think about that. So there might be nice opportunities, without a doubt. Every kind of challenge and crisis presents opportunities for the highest quality companies whose prices unfairly got punished. Then again, how lucky do you feel that you're going to grab the quality ones, right? That's easier said than done in some cases. So for some of you, financials are probably a little bit more of a hands-off from a trading perspective right now. But eventually, they'll bottom out, and there'll be some opportunities, so we'll keep our eye on that as well. All right, let's go ahead and pop back on over here to the main part of the platform, and let's do some 12 grid analysis, starting with, let's see, where am I at? Here we go, chart 5A. This will be our asset class 12 grid. And a reminder that the background colors of these 12 grids will determine what our posture is according to the market forecast technical indicator. When the charts are pink, that means that the current posture is bearish. When the charts are green, means they're currently bullish. And so let's go ahead and get started here in the lower left-hand corner, as we did the last time around, and talk about the US dollar. Now, as I mentioned to you guys, because I was with you right here on this candle, and we were talking about the big day that the US dollar had to the downside, so big to the downside, in fact, we plotted a oversold cluster signal. And I said, be aware that there's a decent chance we can get a snapback rally. It does not have to be trend changing. In fact, it was my expectation, and I said so as much, that it would not be trend changing. But we simply were due for a bounce there. And when we're due for a bounce in the US dollar, typically gold prices fall. Well, wouldn't you know, the very next day after I said that, that's exactly what took place. Now, it's not that I have any sort of special insight or anything like that. I'm just reading these charts that are available to all of you premium market scholars, of course. So no surprise, we had a really strong kind of reversion to the mean type of a rally on the US dollar, which led the opposite on gold for a couple of days of sell-off. Well, after two pretty significant days, we're back kind of falling into the same vein of where we were previously. In other words, the US dollar slipped today, kind of still falling in that intermediate term downtrend, and gold rose today, still kind of falling in line with that intermediate uptrend. So I don't think the previous trends are in jeopardy right now. Then again, things change, right? That's the whole point of having the analysis as often as we do with these videos and everything that you do as a trader. So right now, I wouldn't read too much into that. It was fully part of the expectations. And now that we've had our moves, maybe we can try to have another launch higher for gold and another push lower there for the US dollar. What we do know is that despite the moves that we had counter trend for a couple of days, the immediate postures did remain the same throughout it all. So in other words, as you can see, the US dollar remains strongly bearish and gold remains strongly bullish given the background colors of the charts. Remember, on these 12 grids, if you needed to, you can right click, maximize the sell. Down below, you will then see the actual market forecast technical indicator pulling up if you needed to confirm it with your own eyes. So we had a down day on the US dollar, an up day for gold. Oftentimes what you'll find is that foreign stocks tend to outperform U.S. stocks on days when the U.S. dollar is down, and we did experience that today in one regard, and that is the foreign developed stocks did outperform the U.S. markets. They actually had a pretty good day. They were up 0.55%. And you can see the U.S. markets, of course, were pretty much flat on the day. However, you will notice that EEM, another way to look at foreign stocks, in this case, these are the emerging markets, so the up-and-coming countries, they actually underperformed the market today. So I'm not sure exactly what accounted for that, but you will see that that is not part of the anything abnormal here recently, because the EFA is way up here basically at 3-month highs, whereas EEM is still down here kind of in the middle of the 3-month range. So EEM has been lagging EFA for quite some time. We've talked about EFA and some of the stocks that have benefited there. I was just on our private Telegram channel for our students. So hello, Linda, if you're listening out there. And she was talking about a foreign stock called Stellantis, which is a car company. Of course, I'm a Jeep owner myself, so I suppose I do my best to support that company, but they're based in Europe these days. Another one that's based in Europe is Ferrari, ticker symbol RACE, a kind of a fun ticker symbol there. That stock has also been off to the races and, of course, is headquartered over in Europe. Not only that, but, of course, LVMH has been on a tear here lately. Unilever is up at new 52-week highs here all of the sudden. And we've talked about Novo Nordisk in the past, and that stock just keeps on ripping to the upside. Not only that, but some of the Japanese stocks have been coming back here recently, with Warren Buffett giving an interview in Japan last week. And of course, he has a huge investment in 5 major trading houses there. And of course, Japan and Europe are the core part of the developed foreign stocks here. So those themes are working at this moment, and in some cases working even better than what we are seeing here in the United States. In the lower right-hand corner, you will see that the 10-year U.S. Treasury yield slipped just modestly here today. We ended at 3.57% interest rate, which, as you can see, is just a hair above the falling 30-day moving average on TNX. So it was good to see that we had this 3-day rally here that did push us over that, but now it had a little bit of a give back, and it's sitting there thinking about where it wants to go next, right? This is another one that we could have assumed we were ready and due for some sort of a snapback recovery, because we had these oversold cluster signals here on TNX on April 5th and April 6th. And immediately following that, of course, we have that big surge higher in interest rates there. Now, keep in mind, when interest rates move higher, typically bond prices move lower. And that's exactly what we've seen over here with TLT. It gave back a big chunk of its move here recently within just the last week and a half or so. We've given back some modest gains there on foreign bonds, and high yield bonds have actually held up better than those other two bond categories. It's probably a good sign for risk appetite when we see that. You'll notice that high yield bonds have their strongly bullish posture according to the market forecast, and they remain above that rising moving average. The other two have pink backgrounds telling us that we have weekly bearish postures, and they have yellow moving averages. Price is now below rising moving averages there. So right now, the leader from a bond perspective is actually high yield, or AKA junk bonds. You'll also notice that Bitcoin had a pretty reasonable day. This has been kind of a runaway freight train to the upside. It's been quite bullish this year, one of the best performing asset classes. It's up 45% in just the last 3 months. Today, it settled at about 30,400, right around that general vicinity. And as you can see from the chart, we are up there near multi-month highs on Bitcoin. So that's another sign, similar to high yield bonds, that we would put in the camp of the bulls. There is a risk appetite out there. People are out there spending their money in the riskier elements of the investment world, as opposed to just hunkering down in the boring, let's say, treasury bonds or utility stocks or something along those lines. All right, let's go ahead and now take a look here at our sector analysis. That'll be chart 5C for those of you following along at home. And when I was with you last time on Thursday, we had a clean sweep of bullishness. I can no longer make that claim because, as you can see in the lower right-hand corner, we do have one laggard here, and that is real estate. It's got that light pink background color telling us that we have a weekly bearish posture. Not strongly bearish, so we have to give respect where it's due, and you can see that real estate is at least above its moving average here, so it's not like it's in some sort of a death spiral or anything like that, but it has kind of just gone a little bit more sideways here recently, whereas we have had continuing advances in other areas. In fact, you can see the financials have made a decent little move here in the last week, showing progress day after day. We've seen nice progress in 4 of the last 5 days on technology. Discretionary has actually been up 4 days in a row. Industrials have had a nice, basically week and a half type of a rally there. Materials are up nicely over the past week. The staples continue to impress. They are now at 3-month highs here. Hooray! As I've said to you guys in the past, you'll get a sense as to whether I'm a happy investor or not by just simply looking at the consumer staples. It is by far and away my largest sector as a dividend growth investor. So when consumer staples are doing well, I'm happy. When they're doing poorly, I'm less enthusiastic. So I'm happier today with consumer staples than I would have been at the beginning of March when they were really underperforming. So they've kind of come back to life here a little bit more recently. So you can see a number of those charts that I just pointed out have had a very nice move in the last week or two, whereas real estate has kind of just tracked sideways. So that's why it's kind of falling back into that weekly bearish posture there. But that's the only one. So that's the good news. For the most part, the market is holding up nicely. Even on the S&P 500 in the upper left, you can see we are very close to hitting 3-month highs. Not quite there, but within a stone's throw. So it could happen any day under the right types of conditions. In terms of which of these charts is the best, at least from a trending perspective, from my eyes perspective, I would still say it's technology. Technology in the upper right-hand corner, obviously is that dark green background color. Obviously, we've got a green moving average, price above that moving average, and we've got a push up once again here with 4 out of the last 5 days to the upside, whereas communications normally would have been in that conversation as well. It's just that they've had a few more selling days here lately. In fact, it's kind of weird because you can't see this very well, but if I were to zoom in here, remember, even on these candles where it's outlined in red, those are down days. And so really, we've had, 1, 2, 3, 4, 5, 6. 6 out of the last 7 days have been down days from basically this point forward. The only up day that we've had for the communication sector is right there on April 13th. So that's a little bit strange, I must admit. I really hadn't really noticed that all that much, but perhaps that's why we saw communication slip a little bit there on the sector selector in their rankings as well. So it's not that they're doing terribly, because obviously they're still up here very close to 3-month highs. It's just that they've stopped progressing, whereas it does feel to me like there is still progression taking place here with technology. And remember, technology is the market's most important sector. It is the biggest sector from a market cap perspective, with both Apple and Microsoft in there. So you can also say that it is the most important sector in the overall outcome of the S&P 500 itself, which is also market cap weighted. So if there was one of these sectors that you wanted to outperform, if you wanted to be bullish the stock market, it would be technology. So right now, you're getting your wish. All right, let's go ahead and get into our trade application example for the day. And we are in a period of time that I'm not particularly fond of from a trading perspective. As an investor, I don't really care about earnings season. You have to remember that if I'm holding a dividend stock for the next 10 years, I will be holding through 40 different earnings periods along the way. So I always say, what's one more up front? If you bought a dividend stock 5 days in front of an earnings announcement, I always tell my students, get used to it, because you're going to be in dividend stocks throughout earnings announcements for the foreseeable future if you indeed are going to accomplish your goal of being a long-term investor. But in a trading sense, which is what this particular free video here on YouTube tends to concentrate on, it's a little bit of a different conversation there, right? There we have an ability to pick and choose a little bit more, and our decisions are oftentimes made upon technical analysis as opposed to fundamental analysis, which would be the case in my dividend class. So, as a trader, my preference would be not to trade through earnings season, but I also know that if I'm forced to put trade ideas in front of you guys pretty much, multiple times per week, I will have to do that on occasion. So I always like to remind folks, just because I'm placing a trade in paper money to show you how to apply the concepts does not mean that you have to follow suit with your own accounts out there. Each one of you will have to decide that for yourself and pick and choose what makes the most sense for your situation. So with that disclosure out of the way, let me pull up a dividend aristocrat, even a dividend king, which is more than 50 years in a row of increases, and that is Target. A lot of people are surprised by that, by the way, when I mention that Target is a dividend king with 50 years in a row of increases. They think to themselves, was Target even around 50 years ago? And my answer to them is always kinda. And what I mean by that is Target is basically the aftermath of what was once known as Dayton-Hudson. For those of you that grew up in the Midwest as I did, you will probably recognize that old department store name. And Target was kind of an afterthought that they had just started on a whim. Hey, let's open up this new store that will just kind of have this discount retailing vibe to it and kind of offload some of our excess merchandise. Well, of course, we all know how things worked out in the last several decades, where discount retailing has basically taken over the landscape in the United States, at least, with stocks like Walmart and Target and Dollar Tree and Dollar General and all those types of companies doing very, very well for themselves over time. So Target these days, of course, known for its core Target brand, not necessarily the department store that it started off as. But anyway, as you can see, Target does have an earnings announcement coming up on May 17th. And so I will just give you the proper disclosures here that this trade will go through that earnings announcement for better or for worse, right? Sometimes it's a benefit because when you're doing something like an iron condor, what I'm about ready to show you here, you get a slight benefit because market participants know that an earnings announcement is likely to come with volatility. And remember, it was this time last year that I was tweeting about both Target and Walmart a lot because they had just had historic drops upon their earnings. It was like something like down 25% in a week or something like that, which had basically never happened to those companies in the previous decades. And so they can move. Traditionally, they don't, but last year obviously showed that that is a possibility. So for those of you that are concerned about that, obviously this is a trade that you're probably going to want to skip. But when a company is about ready to have an earnings announcement, implied volatility goes up. If you're the seller of options contracts, that can have a positive impact on you in that it allows you to receive more credit because you're taking on more risk, or it allows you to push your break-even strikes further beyond where they would be without trading through an earnings announcement. So that's why I say sometimes there's something good that's kind of embedded within that situation, but whether those goods outweigh the bad of a stock completely collapsing or soaring on an earnings announcement and taking out your break-evens, that will only be discovered in time, as it gets traded. So each one of you will have to kind of decide that for yourself. But you can kind of see what I've drawn up here. I traded the June contracts. Remember, the trade's already done. As always, I sent this out to those of you that are premium members on our Trade Alerts Telegram channel. So that way you guys have an opportunity to think through the trades for yourself before the closing bell. Gives you a slight informational edge over everybody else that just watches the free videos on YouTube. And then what I ended up doing was the June contracts, so the June monthly contracts. And I sold an iron condor. And for those of you that are newer to that trade idea, it's a neutral strategy where you're not really picking a direction that you want the stock to go. In fact, it's the opposite. You're hoping the stock goes pretty much nowhere. And so you can see I've got two lines drawn on the chart here. One of them up at the top, one of them at the bottom, and that is where my break-evens are for this particular trade. So what I want to have happen for Target is for it to stay between these two blue lines between now and the middle of June when those contracts expire. And as you can see, the break even on the top side is $186.30, and that is well above the prior 3-month high of $181.70. And then on the downside, my break even is at $143.70, and even that is slightly below the low of this 3-month chart back here on January 24th. But remember, this candle wasn't really reality either. So that was the day that I think probably a lot of people have forgotten about by now, but it was quite the dramatic day in real time. And we were, of course, talking about it in these videos here. So many of you probably remember us talking about it. But that was the day when there were a couple dozen stocks on the New York Stock Exchange that just had dramatic movements that had nothing to do with their own news or anything like that. It was a mechanical error that was taking place over at the New York Stock Exchange, which was not allowing orders to flow through naturally. So apparently they decided to let the orders stand in terms of how the candles affect the technical analysis, which I'm not sure I'm a big fan of, but it is what it is. The point is, even despite this very erratic candle that you see right here that probably wasn't reality for most traders, our break even on the downside is still below even that crazy day right there. Now, can it happen? Of course. As I mentioned last year at this time, Target's stock absolutely collapsed. And so could it happen again this time? Sure. Anything is possible, right? And that's why it's important to position size properly and also to diversify your portfolio and have other risk management techniques involved. And one of the things that you have with an iron condor is you have defined risk. That's one of the features of this type of a trade. You know what your worst case scenario is as long as you leave the trade on as you originally placed it. Sometimes people start to unwind their iron condor and it ends up biting them in the hind end or shooting them in both feet because they think that they've gotten out of one and then they go to max loss on the other one. So as long as you're getting into the iron condor and out of the iron condor in the same way, then you have defined risk with the trade. And so you can position size, asking yourself, well, how much risk am I willing to take? And of course, what you would do to figure that out is look for whatever your spread is or your width between your strikes. In this case, these were $5 wide iron condors, where on the top side, I sold the 185, bought the 190 calls. And then on the downside, I sold the 145 puts and I bought the 140 puts. So those are $5 wides between those strikes. And what I received in credit was $1.30, which is over that 30% return on risk that we tend to shoot for with these types of credit spreads. And so my break even on that is $1.30 away from where my strike prices were. So $5 minus $1.30 will show you what you're risking in this, and what you're risking is $3.70. So what you're gaining is the $1.30. So your risk on this trade would be $3.70 per contract. So that equates to $370 in total. But obviously, odds are highly in your favor that you're not going to see that bad of a hit, because the stock would have to go from a current $162 down $20 per share, or up 20 some dollars per share before those strikes are threatened. If they are, because of a really erratic earnings announcement or anything else, then you do know what your worst case scenario is, which in this particular case would be that $370. Okay, so that's what I had for you here today. I appreciate you stopping by and checking it out. Not as crazy of a day as what we've had here earlier in the year. It was a little bit of a snooze session here today, but a lot of our trends have kind of held in place for the most part. As things change, of course, we'll be the first to report them to you. So thank you so much for checking out the video. If you got value out of it, I ask one simple request. Please click like for me there on Twitter. I'll be back with you on Thursday, one way or the other. If we're over 100 likes, I'll be with you for an hour or thereabouts on Thursday. If you would prefer just 15 minutes, then don't click like. And if we're under 100 likes, then it'll be a nice and easy one for you there on Thursday. So until then, I want to wish you all the best of success with your trades and your investments. Goodbye for now.